Good afternoon, everybody, and welcome to today's first online session of Compliance Café. For those of you that are new to these sessions, Compliance Café has been designed to support ongoing professional development through discussions on real-world regulatory and compliance challenges. Our ultimate aim is to provide a platform for sharing insights and practical approaches on these challenges. So thank you all for taking the time to join us. We're very pleased to have compliance professionals, risk specialists and board members joining us from across different jurisdictions. Today's session has been organised in collaboration with Muinmos, a RegTech firm working with financial institutions globally on client onboarding, lifecycle management and regulatory compliance processes. We're very grateful for their support in helping bring this discussion together. And I'll be introducing Remonda, CEO of Muinmos, later in today's webinar. A little bit of housekeeping. Those joining us from a desktop can submit questions through the Q&A function. We will endeavour to answer as many of those questions as possible towards the end of the webinar. And submissions are anonymous, so please feel free to ask those questions that are going to get you the most value out of today's session. Our topic today is rethinking AML client risk categorization, specifically how institutions can move from traditional static classifications towards a more dynamic and defensible approach. Brilliant. So I guess I want to start with a simple question. How many of your high-risk clients are genuinely high risk? And how many are there because your systems can't reassess risk fast enough? Well, in many organizations, a substantial portion of clients are labeled as high risk, and this is often due to assumptions rather than behavior. Today, we'll explore how regulatory expectations have changed, why traditional risk categorization no longer works, and how RegTech can help compliance teams classify risk more accurately, more defensively, and more proportionately. So why does client risk categorization matter? Well, it sits at the very heart of any AML framework. It determines where attention, scrutiny, and resources are applied. The risk rating assigned to a client dictates how much due diligence is performed, how frequently the relationship is reviewed, and how intensively the client's activity is monitored. So in practical terms, it determines where compliance teams spend their time and where organizations spend their money. If the categorization is proportionate, then resources are focused on genuinely higher risk relationships. If it's not, then effort is either diluted across too many clients or concentrated in the wrong places. Misclassification also creates a false comfort and blind spots, and it can be very dangerous in both directions. If you overestimate your risk, then it can overwhelm your teams and create noise that obscures genuinely suspicious activity. But underestimating risk also creates a false sense of security. In both these cases, the organization may believe it's well protected, but in reality, these critical risks remain unaddressed. It is also important to note that supervisory expectations have evolved significantly. Regulators are no longer impressed by how many controls an institution has in place. Instead, they focus on whether these decisions are reasonable, documented, and proportionate to the risks involved. In other words, the emphasis has shifted from how much did you do to why did you do it and was it justified? Ultimately, effective AML is not about applying the most controls. It's about applying the right level of scrutiny to the right clients and for the right reasons. So many institutions, especially that I've come across, client risk categorization frameworks were designed for a very different operating environment. One that has slower regulatory change, more face-to-face interaction, and less data complexity. These traditional approaches, they often assess risk primarily at the onboarding stage or at fixed review intervals. The challenge here is that client risk does not remain static. Ownership structures can change, sanctions can evolve, business activities can shift, and external exposures can emerge. As a result, by the time a periodic review actually occurs, the recorded risk rating may already be out of date, and oftentimes significantly so. So this creates a gap between your perceived risk and your actual risk. Many of these traditional models rely heavily on predefined scoring rules. So, for example, assigning automatic weight to certain channels or customer types. While this provides consistency, it often lacks nuance. The outcome is that large segments of the client base are pushed into these higher risk categories, not because of demonstrated behavior, but because of these broad assumptions. In addition, a lot of the policies that I come across often accumulate very conservative assumptions, and this leads to inconsistent outcomes. So inconsistency is always going to be problematic, and supervisors really expect comparable risks to be treated in comparable ways. Now, taken together, these factors do not necessarily indicate weak compliance, but they indicate models that struggle to keep pace with today's dynamic environment. So why is this no longer sustainable? Well, the limitations of traditional risk categorization models are no longer just theoretical. They're now creating tangible operational and commercial challenges. An inflated high-risk population makes it difficult to distinguish those truly exceptional cases from the routine ones. It reduces the effectiveness of your enhanced due diligence. And ironically, it also makes it harder to actually spot genuinely suspicious activity. In general, enhanced due diligence, frequent reviews, and intensive monitoring, they're very resource-heavy activities. So in effect, your resources are consumed by volume rather than risk. It's also key to note that high-risk classifications often trigger additional document requests, delays in onboarding, and restrictions on services. And anybody that has seen communication between business development departments and compliance departments can understand that for legitimate clients, it leads to frustration. We've seen it leading to them abandoning the onboarding process and even relocating to less regulated providers. So this subject will affects your competitiveness as well as your compliance. Now, across the globe, regardless of the jurisdiction, we've seen a clear and consistent regulatory shift. Bodies like the Financial Action Task Force, Basel Committee, they've all reinforced the same principle. Anti-money laundering must be risk-based, outcomes-focused, and proportionate. So institutions are no longer assessed only on whether you follow procedures, but on whether those procedures are effective in identifying and mitigating financial crime risk. In practice, this means firms must demonstrate that their controls actually work, not simply that they exist. Supervisors also expect risk decisions to be applied consistently across the organization and over time. So comparable clients should receive comparable treatment. Equally important to all of this is auditability, the ability to reconstruct how a decision was reached and what information was used, as well as who approved it. If a decision cannot be traced and explained after the fact, then regulators are likely to question its robustness. Client risk today is multidimensional. Historically, risk assessments relied heavily on relatively static factors, geography or customer type, or the products used. While these remain relevant, there's no longer, it doesn't capture the full picture. Today, institutions must account for a much wider set of influences, including the fact that sanctions regimes evolve rapidly and can affect clients indirectly. The fact that ownership structures may be complex or opaque. The fact that clients often operate within broader ecosystems of platforms and intermediaries. And the fact that increasingly relationships are entirely digital, meaning you're probably never going to meet the client in person. So one of the biggest challenges is what we might call temporal risk. This is the idea that a client's risk profile can change even if the client does nothing. So for example, new sanctions may be introduced. In these cases, it's the environment that changes around the client, not the actual client. So risk today, it's dynamic even without client action. Now, focusing on sanctions, sanction risk in particular has evolved dramatically in the past decade. And given the geopolitical climate of what's going on right now, I don't envision it changing anytime soon. So it's no longer a case of screening names against static lists. It's become much broader, much faster moving, and significantly more complex to manage. today, you as institutions, you're having to navigate multiple overlapping sanction regimes. Sanctions now extend beyond the individuals to entities, sectors, technologies, even activities. So updates can occur with little notice, meaning that your risk exposure can change overnight. So it requires you to treat sanctions compliance as a continuous process rather than a periodic check. Now, when it comes to sanction risk, the risk increasingly arises not only from direct dealings with sanctioned parties, but actually from indirect connections. So secondary sanctions can apply when a company engages with counterparties that they themselves have had exposure to sanctioned jurisdictions or entities. So as a result, institutions must consider supply chains, intermediaries, and beneficial ownership, not just the immediate client you are onboarding. As I mentioned before, modern sanctions often target specific sectors or types of activity rather than entire countries. So, for example, restrictions may apply to energy or defense or finance or to the transfer of technology. So the shift we're seeing is moving from the focus of who is the client to what is the client doing. Now, as we know, sanctions breaches carry substantial financial penalties, but really the reputational impact can be just as equally severe. So in short, sanctions risk today is dynamic, indirect, and activity-driven, making it probably one of the most challenging areas of modern AML compliance. Now, historically, remote onboarding was treated conservatively because identity verification relied heavily on physical interaction and face-to-face meetings. However, this has completely evolved, especially post-COVID. International guidance, including from the Financial Action Task Force, recognizes now that digital channels can be secure when they're supported by the appropriate controls. In other words, the challenge itself is not the risk, but the controls around it are. So what actually determines risk? Well, this can include the quality of identity verification methods, the ability to detect fraud or impersonation, and the robustness of your ongoing monitoring. A key shift in thinking is that onboarding risk should not be seen as fixed. The strongest models that I have come across treat the initial risk assessment as provisional, something that can either be confirmed, refined, or reduced once the real activity and behavioral data become available. So post-onboarding monitoring plays a crucial role in validating this original assessment. Ultimately, effective risk management in the digital world is not about avoiding remote onboarding. It's about ensuring that the strong controls exist and they continue throughout the client life cycle. So while digital channels introduce new risks, they do also enable controls that were not possible in the traditional onboarding environments. So in many cases now, we have digital onboarding with biometric verification, we have liveness detection and behavioral monitoring, and they are much more robust than those traditional face-to-face onboarding. Technology can reduce impersonation, it can reduce document fraud, and very importantly, it can reduce human error. So taken together, these technologies allow institutions to verify identity more rigorously, detect anomalies earlier, and continuously reassess the risk. So it's strengthening rather than weakening your control framework. So across jurisdictions, regulators are remarkably aligned on what good looks like. A strong AML risk categorization framework will be risk-based, it will be proportionate, it should be technology-enabled, it should be clearly explainable, and it should be consistently applied. So it reduces unnecessary de-risking and strengthens actual financial crime prevention, which is the whole point. Regulators are getting less concerned about whether you use 10 tools or one, but they're very concerned if your risk decisions cannot be traced end to end. Okay, so let me summarize the key implications for institutions. First, these are the key takeaways. First, client risk categorization must be dynamic rather than static. So risk profiles change over time, and these can be often due to external factors. So we need to understand this as a starting point. Second, by over-classifying, you are not making your firm any safer. Having these large high-risk populations will dilute attention and reduce the effectiveness of any enhanced due diligence that you do. So it's not safe to just name every client high risk, perform enhanced due diligence on every client, and sort of tick all those boxes, thinking that the regulator is going to be happy with that decision. Another key thing to take away today, guys, is that technology allows institutions to apply controls more proportionately by reassessing risk continuously rather than periodically. So technology can work in our favor if done in the correct way with the correct controls. And finally, regulators increasingly expect decisions to be transparent. They expect you to be able to explain them, and they expect you to consistently apply them. So I'd like to leave you with one final thought. For many years, the industry equated stronger compliance with stricter controls, but the direction of travel globally is slightly different. The most effective AML frameworks are not those that apply the most controls, but those that apply the right controls to the right clients at the right time. In short, and as my slide states, the future of AML risk is not stricter, but smarter. Okay. Fantastic. Brilliant. So thank you for your attention, guys. I'm very pleased to be joined for this discussion by Remonda, CEO of Muinmos. Remonda brings a particular valuable perspective to today's topic through her work with financial institutions. And she's seen firsthand the operational challenges firms face when trying to apply this risk-based approach in practice. Her experience working across multiple jurisdictions also provides quite a unique vantage point on how AML risk management is evolving and where technology can realistically help you meet your growing regulatory expectations. So, Remonda, thank you so much. Welcome, and thank you for joining us.
My pleasure. Pleasure to be here. Thank you for inviting us.
Brilliant. Thank you so much. So I guess let's get straight on to sort of the discussion at the core. I want to understand from your perspective what sort of patterns that you've come across with institutions that most of firms are unaware of at this time.
Yeah, your presentation actually, Anastasia, set it quite nicely. One thing that we do see that's becoming pretty common is the copy and paste. Unfortunately, as you probably can imagine, copying a system from some other institution and trying to apply it is never going to work. Why is that? Primarily because you need to know your client. I think we need to start maybe the session from our side by actually doing two things. One, knowing your client and loving the data on your client. You manage to do both really well. I think this session, probably the next so many minutes, will become a lot more interesting and exciting to the discussion. So that's one area that we definitely feel is a common pattern. What works in one is assumed to work in another, and it doesn't. Because as you quite rightly pointed out, who are you dealing with? What type of clients are you onboarding? Which jurisdictions are you targeting? What type of products are you offering? And of course, the list goes on. And in particular, also you mentioned on the counterparty side as well. So absolutely, if something works in one organization, one institution, one bank, it's definitely not going to work in another. Another thing we do see is what you also mentioned is over-reliance on static data. And unfortunately, those days are really over. What you've pretty much onboarded the client with today is not necessarily going to be the same tomorrow. And there is definitely a pattern of seeing a lot of institutions, banks, any form, firms, etc., that feel that we'll just refresh and do a check in 6 months or 1 year based on the risk. And unfortunately, that doesn't work anymore. Why doesn't it work anymore? Primarily because the data is becoming much more available to such institutions, firms, etc., which means that if I was sitting on the regulator side, I will definitely expect much more a reliance on what's available out there, because those feeds are really easily accessible these days compared to, let's say, X years ago. I've been in the industry for over 23 years. And if you ask me, how did it look like then? It's pretty different from how the market looks today and how data points are gathered today as well. Another thing that really we get sad seeing actually is the siloed level of these type of data points. You often see a department dealing with the onboarding, another legal department dealing with other aspects of it, maybe a risk team dealing with risk, but they're not communicating together. And in particular, if technology is not actually connecting the dots between them, it's very much left for them to figure out what happened at stage A. And I'm trying to drag some data points to B and C, but ultimately they're not communicating, which means, of course, manual errors are going to happen as well. So these are I would say the obvious patterns that we typically experience when we are looking at what is happening in the market today.
Definitely. And I 100% agree with you in terms of my experience in auditing firms. This communication that you mentioned at the end between sort of risk and AML, sometimes I've come across entities that there's no communication between these two departments. Exactly. And really it should be an ongoing communication that is constantly happening. Because as we've already said, risk is really always changing on a day-to-day basis. Exactly. So what would be your sort of one piece of advice to compliance leaders who they're trying to modernize their AML frameworks right now? What would be your one piece of advice to them?
Yeah, I mean, as you pointed out, what regulators look for, there's absolutely no question that they are expecting technology to be an enabler. But having been in technology myself for over 2 decades, and of course, I'm a massive promoter of technology, I would say before they get to a stage of looking for a partner, looking for a provider, they need to really start figuring out their logic internally. No provider can offer that without understanding the obvious. Who are your clients? What do you do? Who are you dealing with? What typically have you experienced to be your risks? And of course, ultimately, a lot of these data points are sitting at the institution side. They're not going to be sitting with any provider. And if you end up hooking up with any technology provider that just gives you boxes to complete, it's not going to really work, because you need to understand your data. These days, there are so many tools out there for experts, of course, in the compliance, legal, risk, to actually utilize and try to, back to my initial comment, love your data. So if they love their data, they're able to really play with it. And my biggest advice would be to individuals that are on this session is get out of words, get out of policies, start really getting into some logic-driven kind of, frameworks where you can see what happens visually. So for us, actually, loving the data is one thing, but take that data, turn it into some exciting formula so you can start really seeing the behavior on your end and try to play with that. Then when you are looking for a provider, or if you are using a provider today, try to utilize those frameworks and inject them into a logical, if you like, driver. So they should be more the medium than the kind of the solution. But of course, ultimately working with providers that understand really the problem at the core, that's where you will get that massive value. But that's definitely another thing I would say. And of course, you need to adapt for tomorrow, which is exactly what you mentioned earlier. Everything's changing. And why is it changing? It's not because the world is getting more complicated. The world has already been complicated from the beginning, but the regulators are getting actually more excited about data. It's down to that, because they can play with it more now. They can see how it can actually empower their auditability, which means that when they go into these organizations, they are already expecting something, and that something is going to look and feel probably similar from one institution to another, bank, etc., and so forth.
Brilliant. And again, another very important point that you made up, that you mentioned there, is the fact that you do have to actually understand the technology that you're utilizing. So again, from personal experience, I come across compliance professionals who have been given the opportunity to purchase technology to assist them in their risk categorization. But when they come to sit and show us the controls, which obviously is from the side of the compliance department, the technology provider can assist you as much as possible, but you're the one with the data, you're the one that has to create the controls based on your specific clients. So compliance professionals do have to have an understanding of the technology that they're using and be able to explain it to regulators once they come in. I don't think it's useful anymore just to bring up a screen of a piece of software and say, yes, this is the software we use. We have to actually explain how the software is used and why the parameters chosen within this software are chosen such so for that type of entity.
And of course, that type of configuration, as this, becomes very easy if you know exactly what you're dealing with. And that's, again, down to once, you know, in our world, at least in my world over 2 decades, it really becomes an exciting formula. Once you perfected it, you can almost take it from one organization into another, because it's not fitting the problem. It's having that really overview of the capabilities of technology and what you're looking for. And then you can almost say, yeah, I can easily design a new framework in another institution or even in the existing one with different changes, shifts, etc., but understanding the kind of connection in between.
Yeah, definitely. Certainly, when you mentioned the fact that we need to move away from words, that really resonated with me, because a lot of firms, if not all of them, just from the base fact that they are regulated, will have policies in place that are usually copy-paste of the laws. Perhaps they're updated just as often as the law is updated. So on surface level, if the firm was to be following word for word the policy, then it would be great. But policies are so broad, they're not specific. So really, once you have the technology capabilities, you've adapted this framework to work for your company, then you go back to the words and amend those words to fit the practice that you've put into place. So this is a really good piece of advice.
In fact, I think actually to put it more bluntly, that should be your first stage. Your second stage is really ultimately you are taking this massive document, having your policies and procedures in this space and really turning it into a very clear visual. That's exactly how technology connects the dots together. Having a document that teams have to go through and do checklists is exhausting. And to be honest with you, it's not rewarding. And it is not moving those humans forward at all. On the contrary, it's making them so massively tired in the process every day. It leaves very little room to move out and start actually rethinking the model and protecting the institution that they are hired to protect.
Exactly. I mean, if a firm was to bring in some sort of technology and software to a system, in your opinion, what's the best way that they can balance efficiency with the need for human oversight? Because I think we both agree that it can't be purely prescripted through software. There always has to be some sort of decision maker, some sort of human input. So what's the best way to balance efficiency and human oversight?
I think it's to once they've moved ultimately from, again, you know, actually, other than loving data, one thing that we do feel is absolutely relevant is legislation. What determines everything here is legislation. Even if there are areas that are ultimately left, you could say, somewhat gray, they're left gray for a reason. And regulators are beginning to actually connect the dots a little bit better, I would say, than if you look back some years ago, which basically means that a lot of it will become more descriptive. We're seeing that already with the Anti-Money Laundering Authority, and we're seeing exactly what's happening there. That's a pattern. If you look back 20, 30 years, the pattern is there. It doesn't, require a genius to come up with what's happening in the market. You can almost predict what could happen in the next years. So let's assume that trend is happening. I would say that the focus should ultimately be STP what you can, because you don't want to end up investing. You've mentioned good stuff actually in your first part, Anastasia, where it's very obvious that there are things today that you don't need to look at. If anyone is reviewing a passport today, it's madness. If anyone is screening manually using, I don't know what they're logging into, is madness. If anyone is trying to search for certain data points that are available with a click of a button, is also madness. If you're sitting with an Excel sheet and clicking, every time a client is onboarded and you're ticking boxes, it's also madness. The list goes on. So I think if those functions really see that, okay, how can I get that manual madness out of my way so I have time to think? I have time to really develop a program that actually works, not just to say, oh, I have X amount of PEPs this week, I have X amount of whatever hits, I managed to go through X amount of false positives. That's also fine. But of course, if you have time to think about them and allowing the technology to assist you, then you are really moving up in the ladder of intelligence. And that's the value of tomorrow. Let's face it. What machines can do today is ultimately, it's not making these functions redundant. I think people are worried about their jobs. It's actually making them incredibly ready for tomorrow. And if they're not willing to do that, I'm going to say it point blank on this call, quit your job and do something else, because this is not going to be fun, especially seeing what the capabilities are out there. And we live this every single day. The capabilities are massive and they're super exciting, but you have to love the levels of what you could push into an STP model and where I want my brain to function, and get excited about that.
I mean, such a fantastic point, Remonda, because it's almost like these checklists, these day-to-day, I mean, let's call it robotic activities that we're asking humans to do. They're not using their brains. When you're not using your brains, that opens you up to error because you're not paying as much attention. And, I get a lot of people saying to me from all sorts of industries about AI and technology and will my job exist in the future? Let's say back office officers. I get it a lot from them. If all this can be automated, then what is my use? And I say this about all technology. Technology has to support us, right? It will never replace us. If you take the opportunity to provide the technology with those STP, those small tasks that are necessary to be performed by a human being. And actually what you end up doing is, instead of your back officers being robots, like I've said, doing these tasks, you actually elevate them into money laundering officers that are thinking logically and using the technology. And I'll say this with all sorts of technology, not just reg tech. Technology is there to support us. If your job can be replaced, then that means you need to grow as an individual. And you have the ability to now, because the technology is going to do that for you. So, I mean, that's
that's super rewarding. And for everyone actually on this call, they should see it as that's what they should aim for. If they come to the office or working from home these days or whatever they do, and their job is repetitive, get out. It means that it can be done definitely better and easier using technology. That means you need to move to the next level and get to the level where your brain is really functioning. You're thinking, you're becoming an analyst in an institution where you're really truly helping. And what that means is you are also empowering the technology you have to the next level, because the capabilities are massive. It's down to the human how far you want to take it.
Yeah, 100%. For those that are a little bit worried about introducing technology and software, perhaps they don't have the knowledge at this point to be able to manage the software rather than the software managing them. Are there any safeguards that you can suggest that institutions can have in place when using AI and these types of technologies in a way that also regulators would be comfortable with?
Yeah, I mean, to be frank with you, I've been in this space, as I mentioned, for decades now, and I would love for RegTechs to get regulated. because it's really, really important that every single institution, bank, law firm, etc., they actually need that comfort of working with a RegTech company that actually really respects a lot of things. One is, of course, data protection is fundamental in this space. Every institution or anyone on this call that is a potential user of these type of technology should ensure that that is really at the highest level. And of course, on top of that, they need to be able to explain everything. They need to be able to inject almost all the logic that I just referenced in the past minutes into a framework where they can explain it. And they need to be able to also, of course, AI is moving very fast and there's lots of opportunities from it, but it has to have the ability to be explained, not only to them, but to an auditor, to a regulator, to any function really in that organization as well. And they need the audit trails across everything. And of course, testing. So even if they use any form of technology out there in the space, they can test it. They can say that actually the expected behavior should be this. We would like to test thousands of different parameters in order to see if it actually mirrors our logic. That requires the human. Again, you know, the human is always going to be part of this, but the human has to be excited about the data, about the regulation, and also about the technology. They don't need to understand, you know, the ins and outs of how the whole thing comes together, but they need to understand the capabilities and how to actually connect the dots in that framework.
Certainly. So some of the safeguards that we've mentioned, certainly for the time being, as RegTech is unregulated, it's not a regulated institution, certainly choosing RegTech that understands the regulation. So they're actually creating things very well aware of the regulatory environment, taking considerations like GDPR into consideration, ongoing testing of these systems, highly important. And understanding the systems you're using, as we've mentioned, is also very important. And all this will also make the regulators feel more comfortable once you've explained to them through the auditability of these providers why these decisions are being made and how all of this is put together in the AML framework.
And often, actually, just on that point, and say that very often a lot of institutions, when they are leaning on technologies, it's of course at the end of the day they're accountable, but they need to be able to feel that okay, we do understand what we are doing. The technology is reflecting what we needed to do, and they need to be part of that journey and not just expect, you know, we'll move it out, let it happen at the provider end. I think it's really important that they get excited about the usability of it as well.
Definitely. I want to bring up something that I brought up in the what I was saying earlier. The fact that companies that utilize risk ratings only at a point in time at onboarding and at periodic reviews thereafter. How important is it in your eyes for institutions to treat risk assessment as a life cycle process rather than this, point in time exercise, which a lot of people are doing now?
Yeah, well, you also referenced that during the first part of the session. Absolutely, there is no question. We strongly believe that all these refreshes will become meaningless at a given point in time, because again, back to what is available readily these days, these data points are readily available with a click of a button. So of course, if you work with providers that allow you to keep monitoring activity, and you know that activity is monitored, you don't need to think about it. Again, let the provider provide you the comfort it's there, and then focus on the areas that aren't. So what could these look like? For example, in the world we all live in, and what typically we see a lot of companies struggle with, of course, is when you are dealing with data that the authorities haven't yet digitized. There is no way to capture that data other than really through directly your clients. Otherwise, of course, again, we preach technology, we adore data. So connecting the dots together and letting these type of continuous monitoring happen by itself is highly effective. But if you are dealing with corporate structures, for example, that are complex, that do sit in jurisdictions where these data points are simply not available because the authorities haven't even digitized them, or if they have not enabled access to, let's say, the world to be able to reach them, which basically means that you need to then think, what can I do in this situation? And in this situation, whether you trigger EDD, how does that look like? What are you capturing? Can you rely on the data? If you are getting data from some sources and there are data points you can't get from any source, you actually, again, need to not only log the data, you need to understand also the capability of data extraction. We have some businesses coming to us to say, I would like to pull all this. And these could be in jurisdictions where I don't need to reference them on the call, but it's virtually impossible. You may need to fly over to the jurisdiction, knock on a few doors, and with luck, maybe you'll find them. Otherwise, there is no other alternative to reach them. And of course, some of I think the market is not really understanding that part. And it'd be really, really good that there is more education also by the authorities on that. And to be frank with you, there are regulators that don't understand some of those data points that they are lacking. So, of course, who do you rely on? You have to rely on your client. If you don't trust your client, then technically you shouldn't be onboarding that client. So there are a few aspects that we feel are really lacking, and that definitely requires not only further sessions on this, but it does prevent that ongoing life cycle, which means that there are few data points you need to capture. But again, Anastasia, if we're looking at the STP modeling, let that ongoing, monitor everything that you can, exploration of documentation, screening hits, all the changes we're seeing. You mentioned it also in the earlier part of the session, and then focus on the parts that you need to really be alert to what you're doing. And who are your clients? Again, back to who are you onboarding?
Yeah, definitely. And in terms of the importance of this life cycle process, I mean, for me, what I come across quite a lot with firms is they're still using the traditional name screening, the sanction screening. That's absolutely fine if you're doing it at the onboarding stage. The problem is, and something that I mentioned earlier, is that it's ever evolving, right? Yeah. And it's not physically possible for an individual to check a name manually every single day to see if that name or anything has come up in the new sanction. And what people need to understand, this is a requirement of the law. This is not the law in all jurisdictions does not state that it's okay just to do your sanction screening once. They're getting smarter regulators. They're understanding that because of the ever-evolving landscape, there are certain things that have to be ongoing, and sanction screening is something that if you are screening a name, for example, using software, once you've entered that name in, you should be getting alerts if that name ever enters, as opposed to these periodic reviews where you may test that name against these lists again. So very important, the life cycle process. And just before we move on to...
And that's also a piece of the major puzzle, right? And so of course, screening is one. But if we're looking at client onboarding, really the whole entire chain, it's massive. You've got the screening, you've got also the corporate structures if you deal, you've got the risk, you've got who are their counterparts, who are you dealing with, you've got the product, you've got the geographies, you've got, did they relocate? There are literally so many aspects that for a human to do this without the enablement of anything is virtually impossible. It's a risk. It's a massive risk if that's what's happening in some of these institutions. So absolutely. And of course, we have to also remember that no data provider out there is perfect. Why aren't they perfect? Because authorities get it wrong. Also, data points are wrong. In some cases, data mapping needs to happen at a massive scale. That now through AI, a lot of this type of cleansing is taking place at a very, very faster pace than ever before. But of course, if you use one provider and you check on another provider, in particular, some of those proprietary data sources that have existed for decades doing this job, they also get it wrong, not necessarily because they're poorer. It's a massive minefield. It's not easy to gather those data points because ultimately a lot of authorities are missing data points when they throw in a name. It could be they misspelt it. It could be they don't have a date of birth on it. It could be they got their jurisdiction wrong. It could be they got many other attributes wrong. Therefore, you're relying on that. And ultimately, at one point, you may get a hit. You didn't get it initially, not necessarily because the source didn't have it, is because the original source, which really potentially could be the authority, didn't have it.
Yes, definitely. I think something else I just wanted to bring up before we move on to the Q&A portion. For me, when it comes to risk categorizing a client, I mentioned that there will always be an initial risk assessment at onboarding stage, but a lot of compliance officers tend to forget that post-onboarding, the behavior of the client, the transactions of the client, all this requires ongoing monitoring. So again, having those certain aspects that can be done through technology automatically, so you can focus on perhaps data points that are not being able to be managed by the technology, but need that human interaction. I mean, a client who refuses to send you documents or answer a call, all these can be slight factors that can amend a risk rating of a client, but it's maybe not necessarily something that a technology can pick up. It's only going to be something that can be picked up by a human. So the importance for institutions overall for this life cycle process is huge. The laws existed for a very long time in terms of, ongoing monitoring. We know these words, we know they exist. So now it's actually being able to focus on that ongoing monitoring, which tends to provide us a lot more driven data points, because at onboarding, if there is a client that's looking to trick you or anything like that, they're going to know what you're asking for. They're going to know how to hide it at that stage. Perhaps a lot of the information you learn is post onboarding and actually once you interact with this client.
Absolutely. And I think what's important to mention here, as we are talking about risk, which of course is fundamental to the session, is we need to remember those clients. If I have an institution asking me for something that they should not be asking me for personally, and says, I will get annoyed. Why will I get annoyed? Because they need to do their job better. So again, we need to be careful that we are not frustrating the client base as we are trying to figure out what we need to do on the other side. And that balance has to happen fast. I mean, when I look at the younger generation, they will just quit. They will say, well, I can't, I have no interest in working with this actually institution. I'm going to switch banks. I'm going to switch providers. I'm going to switch whatever. So I think we need to really, really pay attention to the fact that some of these requirements are becoming not even, it's a hassle. It's a waste. It's a waste of everyone's time, the client, including the institution.
Yeah, I mean, a personal anecdote from myself. I had recent communications with a bank that I use, and I know that they were asking for things that were unnecessary because I had preempted everything by providing everything that they wanted, every explanation, knowing how the system works. I have an insight into what they need. And then I remember sitting in a meeting and being asked for things. And I was saying, but why would you need that? And as you said, I mean, my immediate response to that was, well, I'm going to take my banking elsewhere if you don't know your job. That was my immediate response. And you'd think I'd be a little bit more understanding.
The typical individuals these days are beginning to understand this area much, much better than before, which means that, yes, they will take their business somewhere else. And that is likely to happen.
And we don't want it to have a commercial effect on any of the people joining this group today. So certainly it's something to consider. Now, we have a number of Q&As that have been sent in and a number of questions that were provided prior to this session. I'm conscious that we have just 12 minutes left, but I want to go through some of them with you, Remonda, that we can perhaps answer together. And I will just state for all the attendees that should we get to the end of the session and we don't have enough time to answer all your questions, we are likely to follow up with either a secondary session or perhaps a white paper where we will go through and explain and hopefully answer those questions and send it all out to you if need be. But let's start with a question that I get a lot from individuals. My firm has a high-risk client population. What practical steps can we take to reduce this overclassification without increasing risk with our regulator? So, I mean, from my perspective, and I think I mentioned it in my presentation, when it comes to overclassification, it's usually because the framework that you have in place is not taking into consideration the nuances of either client. So you'll have these rules in place. For example, non-face-to-face equals high risk. Now, because of the nature of the industry, pretty much every client you have on your books is therefore high risk. Therefore, all need the same level of enhanced due diligence, all need the same level of time and energy. And you're just working through numbers there, aren't you? So I guess the first piece of practical step that I would provide is to look at why your high risk client, why you have such a high risk client population in the first place. Once you find those triggers, then you can understand whether those triggers actually need to be in place and start manually assessing risk slightly differently so you can apply energy and time. But from a sort of a technology point of view, is there any practical steps that institutions can take with regards to these high risk populations?
No, but it's exactly as you mentioned, Cezia. If you have these type of attributes that by default, they are high in your type of business. It could be, for example, we have some clients trading in crypto, and some regulators say, well, that's by default high risk. That's fine, but you can't have your entire client base high risk. Then you can't differentiate between what is really high versus what is high actually because it is high. So that's where we definitely assist the clients in actually saying, okay, by default, my client is high risk because of ABC. Because of that, I need by default XYZ. And therefore, now I'm going to focus on the other risk attributes that have nothing to do with those risks. That's very, very easily doable. Once again, you understand who you're onboarding. As you mentioned, one key, one classic non-face-to-face type of onboarding. Then, of course, there is no point putting your entire cluster of clients in high risk because of that. You know they're already high. What do you need to do to at least tick that box, default it, and then move on to the next one? If it's another default, again, figure out what would you do in this situation, default it and move on. Then you're left with the risks that are real. And that's what I would love to see if I was sitting on the regulator side and I'm actually measuring, okay, what is real risk versus, of course, you're in this risk business. It's likely all your clients are going to default into that. We don't see that very often, actually. We see very much, either a cluster of all sorts of risks that by the end of it, you don't know where the risk is anymore. You've lost track, actually. And that's really, it's a shame to start seeing that. But that's because very often it's exactly what you mentioned, says they've checked few risk attributes which already push their client base into the same zone.
Exactly. It all comes down to one size does not fit all. One rule does not apply to all. Certainly, if, as you mentioned, with crypto providers or people that accept crypto, companies that accept crypto as a deposit, for example, yes, the law states that these are high risk clients. Crypto is high risk. We know this. Everybody knows this. But being able to categorize within the high risk category into, I don't know, another 3 sort of categories: high, medium, high, low. Even that's a starting point. But that very key thing that you said is, a lot of these people might be pushed into the high risk category because of one factor. They work with crypto, whereas everything else is not high risk. So there, it's important to understand, okay, this person is high risk, but how do we deal with this client? Because actually the only real risk comes from A. It does not include B, C, D. Therefore, we're not going to bother the client with B, C.
Because you've already taken them into account. You've already concluded the next steps of what you are going to do. And let's face it, those steps are going to be the same for every client. So there's no point reinventing the wheel there. It's exactly the same. You know you need them, you will manage them, and then you move on. And then you are really, truly spending time on the real risk attributes and not just having your entire risk profile hitting, one, almost, we call it red, amber, green, and then you end up actually handling everyone the same way. That is a recipe for disaster.
Yeah, I completely agree with you. Now, I want to bring up one of the Q&As that we had that I'm going to read out. So traditionally, institutions and regulators have considered PEPs, politically exposed persons, and sanctioned individuals as the highest risk categories of clients. However, in Mauritius, we are now seeing the regulator place much greater emphasis on the source of funds, with particular scrutiny on crypto-related transactions. So it's something that we've mentioned. How do you see this shift in regulatory focus impacting risk assessment frameworks and compliance practices across financial institutions? And I think almost in a sense, this has kind of been answered by the first question. So we can see that a lot of people's focus is on the same subject here. These traditional high-risk clients, be they PEPs, be they sanctioned individuals, be they from high-risk jurisdiction or crypto-related transactions, regulators are now seeing that there needs to be nuance between the levels within each of these. I mean, do you agree that regulators are placing more greater emphasis on source of funds now and on crypto? Is that a focus?
I think it's back to the initial comment we just made, that if you by default, if your clients again, if you have, for example, well, hopefully you're not going to onboard a sanctioned person. So I think we can just push that a little bit to the side. Let's assume we're dealing with a PEP. Of course, if you are gathering documentation on source of funds, source of wealth, etc., and ultimately, it's back to one of the comments I made earlier, and that is one of the biggest problems, is ideally in our world, at least my world of decades now in the space, is I love verifiable data. I love clean data. I love data I can actually rely on. And of course, a lot of these documents, you could say, that you gather, typically in this particular area, a lot of it is coming directly from the client. And of course, we see so many of the market focusing on, oh, has someone tampered with it? I'm getting now a copy of their source of funds, and oh, I can see my technology is telling me it's tampered. And all you have to do is snip it. I can snip my bank statement, put it in, all of a sudden, oh, it's tampered, you faked it. So I think we need to really move a little bit away from that and try to figure out what are typical sources where you could almost gain a bit better a documentation or framework. And there are ways of doing that. You know, you could, as a compliance officer, you could actually have a quick call with these clients, get them to take you onto their portal, see it, verify it. It's probably by far better potentially than gathering something, or you have to rely, depending on which client you're onboarding, from which jurisdiction and what you're gathering. But this is one of the biggest problems, actually, Anastasia. The problem is a lot of people are gathering information and they're immediately getting the technology, say, oh, it's fake. Then you go back to the client and tell them, sorry, your document, I can't accept it. They don't understand why. And that's because the technology is not really fit for the purpose that it's trying to achieve for that. So there are lots of issues around that. And we are writing actually a white paper specifically on that topic. So I'm really excited to go into that, because there's a lot of issues around that as well. So to answer this question point blank is, again, you're moving from, you know, all sorts of data points, trying to say, well, how can we verify this with 100% certainty? Today, you can't. It's virtually impossible.
Agreed. And listen, I mean, a couple more questions that I'm reading here. A lot is related to crypto now, and we have to understand that from a regular's perspective, laws are still ongoing. They haven't been written 100%. Anybody that's aware of the AML directives in Europe, for example, they'll notice that every time another AML directive comes in, they're trying to close gaps that were not previously closed in previous legislation. So when it comes to crypto, we're going to see the market change anyway. The travel rule, for example, is a big one related to crypto. Anyone who's been receiving crypto, for example, will be asked who sent it, from what platform. So this is an example of regulators putting something in from a legal point of view. But how it affects your risk assessment, really, I think the point that we've been trying to get across here is that whether regulators define certain types of person or certain types of crypto as high risk, you need to verify what you can verify and really understand the system behind it, even beyond what the regulators understand. And I've seen it many times where a regulator has come in and has said something, it's quite clear they don't fully understand what's going on. And actually the companies that are doing this are far more advanced than the regulators. So always having justifiable, auditable decisions. Just make sure your framework encompasses everything. You do as much as you can from sources that are open for you to collect information, so it doesn't impact your clients. And just understand that if you can justify it, if it's auditable, if it makes common sense, if it's in line with the spirit of the law, which is you're trying to fight financial crime, then that's absolutely the direction that you should be heading. So thank you so much for this question. I will go 5 minutes over just to answer one more question that we've had come in, and it's actually a very specific circumstance that they're relating to, and it's a bit more technology driven, so I will pass it over to you, Remonda. But how do you deal with over-the-top compliance question in the case of onboarding with a cryptocurrency exchange? This individual had a situation where a crypto exchange asked for a Satoshi test to be conducted on the wallet by one of their clients who'd sent Bitcoin to them. The request was technically not only ridiculous, but also felt like they were trying to shut down our onboarding. How can an entity, should I say, deal with these types of ridiculous requests without jeopardizing their own onboarding process with a service provider?
Okay, so the request came from a service provider then?
Yes.
I think the problem you're going to encounter is unfortunately a little bit similar to what we mentioned earlier, as you mentioned, your bank asking you for something that technically you feel, please don't ask me these, stupid requests because you can gather all this. It's unfortunately in a similar fashion, and that's just education in the market. And the problem we're experiencing, which I would like from our side to end with, is every person, whether on this call or otherwise, in the compliance arena, also whether it's crypto or not, you need to start understanding the business. I think a lot of, unfortunately, you could say, how can I call it, breakpoints, is very often we meet a lot of the lawyers or the regulatory experts, but they don't really understand the business that they're operating under. And of course, in this particular case, likely the provider, maybe we don't know who the provider is unless they mentioned it to you in the chat, but likely the provider probably potentially has, unfortunately, a team that has absolutely no clue about this area. And unfortunately, how can you, typically, if you could provide a legal opinion or throw something at them, if it's fundamental to your business to operate, I would probably reach the executives and try to actually say, guys, this is ridiculous. Can we please, show you why and how? And I would say typically a lot of these executives are really willing to listen. Very often, Anastasia, there's disconnect between the legal, compliance, regulatory, and business. They don't talk to each other. Yes. And if I do, if I'm sitting in a bank and I'm siloed myself and I don't understand actually the activities of my bank, what am I going to do? My service is really there, have no value.
Yeah. And I think you'll find that at the end of the day, if you are willing to converse with these, let's say, cryptocurrency exchanges, already you're showing a good faith in the fact that you want to work with them, but you also don't want to go above and beyond for someone that clearly doesn't understand what's necessary in this field. So a couple of things that you mentioned, certainly taking it above that particular department, asking to speak to an executive. An executive should have a better overall understanding, but also they're the ones that control the risk appetite of the entity as well. Exactly. So they're the ones that can make the decision of, what, I've conversed with this person or I've met with this company. I'm happy to onboard them because I feel placated that it's not as risky to onboard them without this test.
And at the end of the day, our job, if I was in an institution, firm, etc., is we need to be business enablers. We need to help the business move forward. It's not about finding the problems, it's figuring out the solutions. And that is ultimately, for me, the crystal goal that every single compliance officer, regulatory expert, lawyers in this space, they need to become the enabler. So it stops becoming almost a cost center. We're there to bring business, we're there to protect the company, we're there to make sure we're doing the right things, and we are going to lean on certain things in order to be able to do that. And then, that's where you start seeing connectivity also in these organizations.
I really hit on a key thing that I have an issue with is there is a big difference between good compliance officers and great compliance officers. And this is not meant as disrespectful to anyone, but a good compliance officer does not have any intention of growing the business. All they are intended to do is to follow the rules that they've been given to follow so that they are not accountable for anything that may happen. Bottom line is great compliance officers understand that they are the line between business being done and business not being done. Exactly. And if business isn't done, no one gets paid, the company shuts down, no one has a job. So you really need to find that line. And in those instances where you may not have the power to make these decisions, you need to take it further up the chain to those decision makers that can. And failing that, in terms of going back to this original question, take your business elsewhere. Because in a sense, that's the only way. If you cannot even reason, and really what you're trying to come across is very reasonable, and no one's accepting it, even at executive level, then that's a hard lesson that crypto exchange has to learn, right? And it's the same for you as compliance officers in investment firms or whatever. Understand that if you are too strong and too set in your ways, then you're ultimately going to harm the business. But there will be places where you want to put your foot down. Correct. And you will have more credence in putting your foot down in those instances that are actually really risky than having just a performative list of things that you want to perform just to tick a box. So hopefully those have answered your questions. We have run 5 minutes over. I do have a number of questions that were sent in that we didn't get to address. But hopefully today's been valuable to all the participants. Remonda, I couldn't ask for a more fabulous panelist to come in and to provide an insight for us on this subject. We will look to follow up with a white paper and or a follow-up session, again, maybe just to answer Q&As. And we invite all participants in the future to become a part of the Compliance Cafe. We'll continually do these online and in-house seminars, hopefully globally, hopefully around Europe and the rest of the world, with the intention of giving you guys some really valuable practical insight as decision makers or compliance professionals. So thank you again, Remonda, and wish you all a very wonderful afternoon.
Thank you.
Take care.